Let's have a broad look at the markets so far. The FBM KLCI, the performance has been stellar. It is up 11.34%. We are firmly ahead of notable markets such as China as well as Singapore. Meanwhile, the US S&P is up 16.58%. They are led by tech stocks, in particularly Nvidia. We also have Nikkei, the Japanese index, up 23.50%. It's currently near its 3-decade high. And zooming in to the Malaysian market, this list over here is the 5 most valuable companies in Malaysia. And you can see that its year-to-date performance is quite impressive. Maybank, the largest and most valuable company in our country, year-to-date performance 13.17%. Now this calculation excludes dividends. So if you want to include Maybank's dividends so far of about 2 to 3%, yeah, they pay dividends twice a year, its year-to-date performance is actually 16 or even 17%. Now looking at other assets, let's have a look at Bitcoin. Yeah, up 34.32%. This is not the most updated chart. In the previous 2 days, Bitcoin did go through a bit of a roller coaster ride. Yeah, retraced to 53,008 before going back up again. I think the current price is about 57,000. Still, it has vastly outperformed traditional asset classes, yeah, especially against the US S&P, the Malaysian market, so on and so forth. And even gold, right? Gold is only up 14.46% since January. I say only, but for gold's standard itself, it's already considered quite impressive. Obviously, this is due to the unfortunate conflict in the Middle East. And a lot of people looking at these charts right now, seeing the markets go up, most of you might be thinking, is it too late to invest or not? Well, nowadays, I no longer look at share price. I no longer look at the state of the market. I look at whether my portfolio is underexposed or overexposed. Now, let me give you an example. Let's say your goal, you want to build a portfolio that looks something like this. Yeah, you want to have 25% in bonds. Yeah, these bonds includes your safe investments, such as fixed deposits, ASB, ASM, as well as EPF, right? Then 10% in gold, sort of like a hedge against inflation, as well as a bit like an insurance. And 5% in Bitcoin. You don't really believe in this asset yet, but you just want a bit of exposure. And the remaining 60% in equities. This one includes your stocks in the Malaysian market, your shares in the US market, your US ETFs, so on and so forth. And right now, your portfolio looks something like this. And this is probably the case for the majority of people. Most of you are probably still investing in very safe assets. 73% bonds or EPF, your fixed deposits, ASB, ASM. Most of the funds you put perhaps inside Aeon Bank or GX Bank. Then a bit into equities, a bit into gold, maybe even 0% Bitcoin. Now, in this case, since your goal is to have a bit of exposure into Bitcoin and a lot more exposure into equities, what you can see right now, your current portfolio is overexposed in bonds and underexposed in equities as well as Bitcoin. So the first most important thing is to at least get a bit of exposure first. Okay, rather than straight away adjusting it to your goal over here, you can probably just enter a bit, maybe enter a bit into equities, enter a bit into Bitcoin, and see where the market moves in the months ahead. So if Bitcoin continues to rally, that's good news for you. At least you already have a bit of exposure. Now, let's say if Bitcoin doesn't rally, and Bitcoin goes down a lot, similar to equities, right? You've put quite a bit into equities already and it continues to go down. In this case, you can see that the weightage, the equity weightage within your portfolio becomes lower and lower. Therefore, you are underexposed and you are supposed to move whichever section of your portfolio that is overexposed into this particular section over here. Now, I know this sounds a bit technical, but at the end of the day, the question boils back down to whether you are underexposed to an asset or overexposed. If you're overexposed, then make sure you move that extra percentage over to whichever asset that you're underexposed in. And this one completely removes a lot of emotion. It's unbiased, and you can see that there is no timing the market over here. Now, how to save more? Well, in order to save more, your first priority should be increasing your income. Yeah, sure, cutting your unnecessary expenses is important, but there's only a set amount of expenses that you can cut before you start eating Maggi every day, right? There is a downside limit when it comes to expenses. But income, as long as you're willing to explore new opportunities, perhaps hop to a higher paying job, or even monetize your talents, right? You'll see your income grow, as well as your savings. So to increase your income, number one, figure out what you're good at. Okay. Then ask your friends and family. At least have a second opinion or a third opinion. And make sure you double check with them, see what you're really good at, what your talents are. And then finally, try and think how you can create value for others out of your talent. Okay. I'll give you an example. For me, I don't think I'm very good at financial terms. Okay, I still have a lot more to learn. But what I'm good at is breaking things down for the layman to understand. So I'm sort of like the middleman, and the experts, they tend to have a lot of technical jargon, and I can break it down into very simple terms for people like you to understand. Okay, so make sure you figure out what you're good at and then find ways to monetize it. On to the main topic of tonight's session, how to read and understand a company's balance sheet. Now, normally you hear people saying, investors saying that, oh, in order to pick the right stocks, you gotta learn how to read a company's balance sheet. But when you go on over to the balance sheet, we don't even know what to look at because there's so much detail, right? In this case, there is a 5-point checklist for you, and for today's purposes, we will analyze Astro and determine whether there is a future for this company or not. Okay, so the first point to this 5-point checklist over here is you take a look at the return on equity. So the return on equity is basically a measure of the financial performance calculated by dividing net income with shareholders' equity. Yeah, you don't even need to know the formula over here. All you need to know is that healthy companies tend to have an ROE of above 10% every year. Now, to give you an example, Apple has an ROE of 147.25%. So it's a very healthy company. And meanwhile, Astro, yeah, it's not looking very good lah. The ROE is only 3.39%. So that is your first red flag already. Now, next one, you take a look at the company's profit margin. Now, this one is pretty important because it measures the company's profitability. So let's say the profit margin is 30%. It means that for every ringgit of revenue that this company generates, it keeps 30 cents. Okay, so obviously a higher percentage means that a company is more efficient in generating profits. So in the case of Astro over here, operating margin has been increasing steadily from 2015 to 2020, from 17.59% to 22.83%. But suddenly, from 2020 onwards, it has halved. Right now, it's only 11.48%. So that is another red flag. So another one is you take a look at the cash flow of the company. So cash flow is the net amount of cash and cash equivalents being transferred in and out of the firm itself. Yeah, sure, a company may have growing revenue, so on and so forth, but if it doesn't convert these numbers to cash, it may mean that the firm is struggling to receive payments from its business operations. There are two figures over here. There is operating cash flow and there is free cash flow. So all you need to take note of is see whether this cash flow is growing or not. So if it's growing, it means that the company is healthy, its business is working fine, it's expanding. But in the case of Astro itself, right? Yeah, this is quite bad news lah. Its operating cash flow has declined by over 50% since 2015. Meanwhile, free cash flow, which is OCF, operating cash flow minus capital spending, has also declined by over 50% within a similar time frame. And the fourth one, assets versus liabilities. Now, this one, I think, is pretty logical. And normally, we want to have more assets compared to liabilities. Same thing works for companies as well, right? We'll talk about current assets and current liabilities. Yeah, so current assets are those assets that are liquid, that can be converted into cash very quickly, within 1 year. And these examples include cash in the bank, perhaps fixed deposits, your receivables, inventory, short-term loans, short-term deposits, so on and so forth. Current liabilities, meanwhile, are the debts or obligations that need to be paid urgently, within 1 year or less. Examples include your creditors, the short-term borrowings, advance from customers, your income taxes owed, all these fall under current liabilities. Now, typically, current liabilities are settled with current assets. It makes sense, right? Because urgent debts need to be settled immediately, right? And in this case, a healthy company tends to have much more current assets compared to current liabilities. But when it comes to Astro, right, you can see that its current liabilities exceed its current assets, which means that it is struggling to repay back its creditors. And at the end of the day, if it doesn't manage to pay back its creditors, right, it may need to liquidate its non-current assets. Yeah, its properties, its long-term investments, so on and so forth. And that is basically a one-way trip to bankruptcy. And this is the early signs of it. The final point is taking a look at the share price. The first four is already red flags. Now, obviously, the fifth one, the share price over here is pretty much self-explanatory. Yeah, Astro's share price since its peak of 3 ringgit and 70 cents in June 2014 has declined by over 90%. Yeah, right now, it's about 33 cents. Previously, it fell to an all-time low of about 29 cents. Yeah, it's 1/10 of its IPO price of 3 ringgit in 2012. Yeah, all because of these four factors that I mentioned just now. And obviously, this 5-point checklist over here, right, is not exhaustive. There's still a lot of things that you can analyze within a company's balance sheet, but hopefully, it will give you guys a good idea on where to start. Okay, if you take a look at a company and four of it is already red flags, then that is an indicator for you to stay as far away as possible from this stock. But let's say if you analyze a company and four of it is green flags, let's say cash flow is good, yeah, profit margin is steadily growing, return on equity is perhaps more than 10%, it's much more asset compared to liabilities, but the share price is not really growing. Yeah, it may mean you've just found an undervalued company. Can explain again on portfolio breakdown like equity and bonds. Okay, so like what I said just now, right? The important thing over here is not to time the market itself, but to understand whether you are underexposed or overexposed. Okay, so after this session, go back, take a look at all your investments, including EPF, and see and do a pie chart like this. Okay, so you have something like this, and then do another pie chart that is your goals. Okay, so these percentages you have to set for yourself, lah. Yeah, based on your risk profile. I tend to do the sleep at night test. You build your own portfolio and then you check whether you can sleep at night or not. If you can sleep peacefully at night, it means that you are taking the right amount of risk. If you cannot sleep at night, it means that you're probably taking too much risk or too little risk. So you fix these percentages, right? And then you take a look at your current portfolio. And let's say your current portfolio is something like this. It's overexposed in bonds. There's too much in fixed deposits, too much in ASB, ASM, too much in EPF already, and too little in equities, none in Bitcoin, also quite little in gold. Let's say you're not interested in Bitcoin, you can always slot in another asset over here. And in this case, getting exposure is very important. If your exposure in equities right now is 0% and your plan is to have 40%, well, as much as possible, you want to have exposure as soon as possible. Okay, so you don't need to enter everything immediately. You don't need to convert your entire portfolio to your target over here. Yeah, because nobody wants to enter into a very high market, and also there's a bit of anxiety lah. In this case, you can just enter a bit, right? Maybe allocate part of your bond position into equities. Just get your exposure above 0%, and then see in the months ahead how the market moves. If the market takes a downturn, your equity position will decline, right? In this case, you will see that you are underexposed in equities. So you have to allocate more from your bond portion. Next one. Hi, Sinji. What points to analyze ETFs? Well, when it comes to ETFs, my approach is quite simple. I only invest in US ETFs, specifically the ETFs that track US indices. Okay, because there are so many different types of ETFs out there, I try to keep it as simple as possible. These are the ETFs that track the US market. So notable ones, QQQ, 100 of the largest non-financial companies on the NASDAQ. So you do have stocks like Microsoft, Google, Nvidia, Netflix, Tesla. All of it is in the QQQ. Then there's the Vanguard Total Stock Market also. 100% of the US stock market. And one of the most famous one over here, VOO. Invest stocks on the S&P 500, which is 500 of the largest US companies. I'm not very clear on the cash flow point. How can this point be analyzed? Okay, let me just explain this again. So now the cash flow determines how much money the business has received. Okay, sure, a company may have very good revenue, right? They are very good at getting business, but if they do not convert these numbers into cash, the revenue doesn't really mean anything, right? Okay, so At the end of the day, when you have a look at a balance sheet, right, you have to see two things. What is the operating cash flow and the free cash flow? So think of it as like real money that you've received lah, and think of revenue as like the money that you haven't received yet. Okay, to keep things very simple. Okay, and if the money that you have received is growing every year as a company, that's a good sign, right? And these two figures, if it's growing every year, that means that the company is at a healthy position and is also probably expanding its businesses. So growing revenue, one thing. The other thing, you also have to check whether the cash flow is growing or not. Okay, so hopefully you guys learned something from tonight's session. A shout out to all our members: Andrew, Wendy, Edward, Alex, CC, Is, Urshad, Caveman, Calvin, Tommy, Jinkang, Adrian, JS, Wenyan, Dean, Duhan, Sufi, Faris, Alan, Jackson, Raizan, Hudson, G, Jeffrey, Lawrence, Lukman, Will, Jack, YC, Arif, Hazik, Jinden, Adam, and Adrian, as well as all of our learner members. And see you guys next week. Bye, guys. Good night.